The double bottom pattern is a bullish reversal pattern that starts with an initial trend that is down. The stock's price action then finds a line of support where it makes the decision to bounce, but that bounce is typically going to be smaller than the initial trend down. That bounce then sells off and you get a test of the support for a second time before the stock's price bounces again. This time, when it bounces the second time, you have the true reversal. This is a fairly common setup out there. You find it all the time, and I love this setup because it offers you a chance to take a trade with a low amount of risk and a high amount of reward. So one way that you can take the trade is to take the entry on the second test of the support. So after the support is tested the first time, you identify where that support is at, and then you take the entry on the second test of that support. Your stop loss becomes just below that line of support, and your price target is going to be anything overhead. The second way that you can take this entry is to take the entry on a break of the neckline. Now, your neckline is going to be the middle of the double bottom or the W. So your entry is here on a break of the neckline, and your price target is anything overhead. Let's take a look at a real life example. I'm on the daily time frame here for Snap. This is going to be bottom number 1 right here, and this is going to be bottom number 2 right there. Here's your initial sell off to bottom 1, your bounce and neckline down to bottom 2, and then your rally up back to the top side. Again, one way to take this entry would be at the bounce of the support line, so anywhere in this area for this move back up. The other way to take this entry would be on a break of this neckline here, so anywhere in this area for this move up. How you decide to take your entries on double bottoms is totally up to you. There's not one way that's better than the other. It just kind of comes down to, do you need more confirmation that the stock is actually bouncing, or do you prefer to take on a little bit more risk under the assumption that the stock is going to bounce? Here is a second example of a double bottom pattern found on the daily time frame. And again, this pattern, much like every other pattern, can be found on any time frame. Here's bottom 1, here's bottom 2. This is going to be initial sell off to the bottom, your neckline, sell off to the bottom for your second test before you get your move higher. Keep in mind, because this is trading, the pattern isn't always going to perfectly set up and test the bottom support line exactly. Sometimes this pattern can be at a diagonal. So here's an example on the 5-minute time frame where we have a double bottom pattern that isn't exactly perfect, yet it still works. This would be your initial sell-off. This is bottom number 1. This is your bounce off of bottom 1 down to bottom number 2. Then here's your bounce back up to the top side. In this scenario, you still can try to take the entry at bottom number 2, but you won't know that you're getting a bounce at bottom number 2 really until this candle starts to happen, which means that you're better off taking the entry in this situation on the break of the neckline here on this candle, maybe about halfway through, or even on the retest of this old point of resistance as a new point of support to catch this reversal move up. That's it. That's all that I have for you on the double bottom pattern. Hope the video's helped you out, and I'll see you in the next one. Cheers.